guys.
Anything? Are we on?
What's up? On? Yeah, we're going.
We're always on.
I want this though,
Lower.
like in front of your face.
And go like right in the middle,
He
like
would
of
know.
the
He's the
diaphragm
radio
up.
guy.
Yeah, there you go. Yeah. So Mike Poyntz.
Man, Mike's a great guy.
He's a great guy.
Do my
Debatable.
best.
Depends on the day.
He's also a great.
Just kidding.
That's fair.
He's a great lender.
Actually, fair.
I'm on the spectrum. Some days
With
he's like, "Hey, it's too far.
Yeah,
Too far.
you're too much.
Be personable."
He does pretty well with instruction.
He's great.
Yeah.
He's great. And when we were deciding on talking rates and stuff, I was like, you know what? This is pretty nerdy.
Yep.
Who's the best
We
guy
need-
to talk through
He's
this
the
with?
nerdiest guy. That
He's the
can do
The king
nerdiest
of the
guy
nerd.
I
5
know.
minutes
Yeah, king of nerds.
without they can't see this whiteboard that I'm going to draw on though, right?
Oh no, they'll see it. It's all up there. We'll just green screen.
It's like Glenn Beck.
The Rain Man, Matrix,
Yeah.
all of it. All right.
Oh my God.
Well, okay. So rates have been the topic of discussion for
A year and a half, 2 years,
a little while now.
5 years.
And not in a good way. And as much as we have tried to communicate to people not to have horse blinders on as it relates to interest rates, I totally understand that it impacts affordability. So it's been rough. How do we get here, Mike?
How did we get?
How did we
here?
get to like the
Yeah.
8% rates?
Yeah.
And then we'll talk about kind of what's happened since.
Well, when we're 80 years old or even 70 years old and our grandkids are, at that point in time, they'll have probably been married. They'll bring people over. We're going to talk about the time that interest rates were ultra low when we thought the world was going to end. And so we just kind of try to get to zero as fast as possible on interest rates. And that historical time period has created such a headwind, it's a hampering effect that we have on homeowners today. So you have a rate that's gone to 8% because, in contrary to these ultra low interest rates that were, sub 4% interest rates, the economy waited way too long. Or I shouldn't say the economy, the Federal
Fed,
Reserve.
yeah.
Let's just get right to
Let's
it.
start
The
pointing
Federal
fingers.
Reserve's waited way too long to readjust these numbers and pull interest rates out of that crazy low interest rate era and back into a normal a range, which I would say is between 5 and 6%. Historically, we have of the last 40 years, we actually started charting the dots. 5 to 6% is a healthy interest rate because it allows price to slowly grow, and it allows the average household to qualify for a reasonable, affordable mortgage. 8% happened because we let people, in addition to having a very low interest rate, not make a payment. Remember those days?
Oh, yeah.
Hey, so why don't we just take the biggest line item on your budget and just not have to pay it for a while?
Sounds great.
Okay, so that means the average American is going to say, oh, I'm going to put this money in a savings account for a rainy day
No.
for about 6 weeks.
Yeah,
And then they're like, you know what would be fun is if we bought a boat because we're home, right? Mm-hmm. And my bubble, my 6 people that I live in can fit on a boat. So let's buy an $80,000 boat. And so people continue to start buying. We're Americans. We live in a consumer environment. And that inflated this economy to such a degree where then once the Federal Reserve finally started acting, they had to run these rates up as long as they could to try to retard the economic
Have they
growth.
finally started acting? I mean, some analysts will call them old and slow. They're letting the 10-year yield do a lot of the heavy lifting. We'll see about the cut in September, right?
Well, I can tell you right now that the cut's happening in September.
Yeah, that's what everyone's
I'm
saying.
willing to go on, on the air and on this
That's
video
right.
screen.
No one listens. You can.
It's going to happen.
It's going to happen.
Hey, my dad will have an
The
opinion.
question
true.
now,
That's
the
true.
question
That's
now is it going to be half a point? This is going to be 50 basis points, or will it be just the beginning of a slow, painful quarter raise or reduction? Excuse me.
Okay, so let's talk. Let's dig in a little bit more detail on kind of the last year and a half. So the data seems to show that it's not the absolute value of interest rates that affects consumer behavior. It's the change in interest rates. So there's a lot of volatility, right? You go from 3 to 5 to 8 to 7. It's like, how do you budget? Clearly you buy a boat, but beyond that, it's like, it's hard to know how to plan for your life when you don't know what your payment's going to be. And those swings make a massive impact on your monthly payment. So I understand that. And then you have some people who believe in a lock-in effect, where if I've got a 3% mortgage, I'm not going to sell my home because 70% ish of sellers are also buyers to buy into an 8%. So if you believe that, then that's another whole, data point that makes it really hard. So you're not getting inventory because who's going to sell and there's another school of thought that says it's holding costs, right? If you have a 3% interest rate, you're much more likely to be able to hold that asset if you need to buy another one than if your rate was at 8, you're much more likely to have to sell that asset to buy another one. So you've got it damaging inventory on two fronts. One is you might not sell, and the other is you might not have to sell. So then we're in this environment that we're in with really low inventory. Still buyer demand is high, I think, even though rates are unhelpful. So it's created a really tough market, right, Jeff?
Yeah.
Yes.
Yeah.
It's been tougher. It's been tougher.
I want to say this: we are very spoiled in this local area, this region of California, that demand is still very high.
Yeah.
You get outside of a place as wonderful to live as the Central Coast of California, and demand is dropping. Mm-hmm. Because inventory is low and the average inventory that comes out is not amazing. I would say doesn't make you want to get off the couch and go see it today. That's an amazing piece of inventory, right? Where you're like, oh my God, I got to call my wife. I got to see this property today. Yeah. There's limited of those, and those that come on in any market are getting pounced on. So it starts to make the average individual, especially the first-time home buyer, say, you know what, I'm just going to wait till more inventory hits the market because this is not a merry-go-round.
So they sideline.
Yeah.
I mean, I think it's interesting, kind of talking on a more macro level, is we are seeing a lot more articles about declining markets, as in home values in different parts of the country. And we're not seeing that here. We haven't really seen a decline. Matter of fact, the median sales price was up the last 2 weeks.
We hit just a new high in 925, I think, in July.
Yeah, July. So it's interesting to see these articles, reflecting the pain in different parts of the country. But I think it comes back to California. Housing is still a massive shortage. This is a very desirable place, and there's still money coming in from other areas that maybe it's not local, but there are locals that are. I'm seeing a lot of local first-time buyers stepping up to the plate, saying, "Hey, this is my opportunity. It's not going to seem to change, so we need to do something now instead of later."
Mm-hmm. Yeah, but let's call a spade a spade.
Yeah,
those who step up have family money. More than half the time, I see people that are like, "Hey, so here's my pre-approval," and I write them back, "Hey, so part of this is that you need to have a down payment. I didn't see any assets in what you sent me. You sent me your pay stub. You sent me, we pulled your credit, but where's the down payment? Oh, my dad is going to give me $300K."
And you say about half of it.
Wow.
Half of the buyers that are I would categorize as first or second time home buyers. These are the people that are buying typically between $750,000 and $1 million. This is their price point.
Yeah.
Half of them have money coming from an early inheritance, or they have it coming from family. And the other half are really second fiddle in the competition market, because they're coming in with I need to have, at least $10,000 in the bank when I close, so I can give you 5 or 10% down. And those people, unfortunately, I don't need to tell you the rest of this story, are going to have to come in and make themselves very competitive to that seller.
Yeah. So and the rest of the story, just for the audience, I think it's they're coming in with less down, less attractive, so they're having to offer more competitive terms to get that property locked up.
Yeah, and the cherry on top of that unpopular flavor of ice cream is that they're like, I'm non-contingent. I'm ready to go now.
Yeah. Yeah, exactly.
So the seller's like, all right, well, that's nice, but I really like the one that's $35,000 over list price.
Mm-hmm.
So if you could meet them, well, I'd be happy to try your ice cream.
Right. Yeah.
Did I lose everyone with the ice cream story?
I'm tracking.
It's like when my kids order
you all right?
bubble gum ice cream. I'm like, let's not eat bubble gum ice cream. Ugh.
Bubble gum, and then they save the bubble gums.
I know.
Ugh,
That's
horrible.
gross.
You did say one thing though that I really want to I want to bring up, that 72% of the current market that's ready to buy will have to sell something to buy. You know, and
What percent?
72%.
72?
Wow.
72%.
I mean, 83% of stats are made up on the spot.
72.6. I'll be happy to send it in.
The decimal makes me actually believe you more. So
Yeah.
Now we know.
But it's news that I think just kind of gets heard and goes away because it's like, okay, well, that's great. They already own something. I don't care for them. You know, I feel bad for the first-time home buyer that has nothing, because will they be the ones that are going to fall into the have-nots when interest rates drop back down? And I know we're going to touch on that, but you know, this is really the calming before the storm for our industry. So the 72%, they're going to do what I think most average individual households do, which is like, we're going to go find where we're going to live first, and then we're going to sell our house.
yeah.
And I think the interest rate, just to bring the interest rate back into this whole like consideration, is that the interest rate really helps them dictate like, okay, now I can go afford houses that are in like the $1.1 million range. That's where we think our next move up is. And we're going to start shopping. Meanwhile, they still have like a half done bathroom and they haven't decluttered their house. And,
Yep.
you know, their kids got a cool little hopscotch chalk thing on the driveway, but they're shopping and then we'll be selling. And I hope that we get to at some point bring up, I know you probably talk about this every week, but at some point bring up like why that's not the greatest plan, is to find your house before you're ready to sell your house.
Yeah.
You know?
Okay, so let's talk a little bit about kind of where we find ourselves now. That was a good deeper dive into where we have been. So then, you know, last week things went a little wild, you know, and rates drop, and everyone's like been waiting. I think this has been the last year and a half. It's like, oh, the Fed's going to do 3 cuts this year, and you're waiting and nothing happens. And then like you see inflation dating improving. You're like, what the heck, man? Well, shouldn't we do this? And then it's like, oh, well, there's like this other thing, the jobs. So we can touch on. So
Sure.
Explain what happened, and then we'll talk about, I think, the sort of levers that created that situation. So what did we see with rates over the last week or so?
Yeah, so the very beginning of August, we started like that first Monday of August at 6.8% was the average 30-year mortgage. By Friday, it had dropped to 6.4%. Very healthy drop. I mean, that's a huge drop. That also means like at 6.8%, just to put it into dollars context, you were paying, no points to get a 6.8 mortgage. And then if you still wanted a 6.8% mortgage on Friday of that week, when rates went down to 6.4, I was now giving you almost 1.5 points back in lender credit.
Whoa.
So I was able to give you $7,000 or $8,000 at closing to have that same 6.8% interest
Dang.
rate. So the banks jumped. Here's why the banks jumped. Okay. And just like I told you in the beginning, the feds wait too long to make a correction. All they have is this blunt force instrument, the interest rate, right? They're not like a surgeon where they're like, oh, I've got a 12 gauge scalpel, I can make this cut. They just get to bang, hit us over the head with an interest rate drop. So they were waiting and waiting and waiting, and everyone in the marketplace is like, what's going on with these rate cuts? I thought it's like already halfway through the year.
Yeah.
But we know that they have that one other responsibility, which is the jobs mandate or the employment mandate, where they have to make sure that a bunch of people aren't just getting kicked to the curb so that the economy corrects. Well, earlier this year, the unemployment rate was 3.4%. And just last week, we finally got our first part of August, when this all happened, we got a jobs report from ADP and a BLS jobs report. Those two are really like, they're the gospel of jobs reports, if you can believe that. The ADP is kind of like the First Testament, but BLS is Old Testament. Did I mess that up?
Old Testament. Yeah.
First, second, third.
Yeah.
So the BLS is like the one everyone watches now, right? It's like the Testament. And both of them said, we're at a 4.3% unemployment now. And we've gone up from 3.4 earlier this year. There's never been a jump that high. That's 0.90%. I didn't make that up. It's real. That hasn't led to a recession.
Wow.
Okay. So now we know that the feds are like, hey, guys, it's time to get off of your fancy chairs from behind your mahogany desks and do something. And it's going to be a fraction of half a basis point. If it's even more, I would not be shocked to really correct this thing. But that volatility has been kind of settled. You know, where we're at now is rates are at 6.5% for a 30-year fixed mortgage. And everyone's waiting now for the rest of this month of August. You know, kids are going back to school. It's like we're properly perched up waiting to see what the feds are going to do in September. And they don't really meet till the second week of September, but we're going to get that ADP and BLS jobs report in the first week of September, right after Labor Day.
Okay, so explain why without the Fed having made a cut, we saw interest rates drop.
Yes. So rates, banks and the interest rate market are looking 6 months ahead. Okay, we're not thinking about Q3, how are we going to do in Q3? We're thinking like all the way to January. And here's why. This is exactly why. We have to price in what we think we can sell to the average American consumer for an interest rate, get them to buy a house or refinance and keep that mortgage for 5 to 6 months worth of payments. Because in the banking industry, you guys, I think, have a tougher job, but when you close, commissions are earned. For us, when we close, that borrower needs to make 5 to 6 payments to the bank for our commission to be fully vested and earned. So if they turn around and say, oh man, rates are like even better. Let's do a refinance. Mike, what's up? Let's do a refinance. That original loan that I closed, if I do a refinance before the 6th payment, is going to have to be given back. So it's really rare that someone buys a house and then 3 months later they're like, you know what, we don't want this house.
Yeah.
Right? Because there's a lot of costs that are incurred with selling.
Yeah.
But it still happens. But that's why you would say, well, but they haven't cut the rates. I mean, so why is the mortgage industry cutting rates? They have finally seen, okay, we got ourselves a bona fide problem here. We are easily going to cut 2 times this year. The question is, are they going to cut big in September? And I think that's what the banks are showing with their cards, is that they believe the Fed's in a position now where they've waited long enough that they need to make a serious, like, headline front page correction.
And that impacts the market and the interest rates drop.
Yep. And if you also, so what does it mean, right? 90 basis points in unemployment means recession's coming. What happened that week in the stock market and equities market?
Oh, yeah.
When bonds improved and mortgages improved.
They went crazy. Crashed. And
Japan crashed. Biggest crash they've had since 1987. The Dow went down 4%, NASDAQ down 4%. But just like these interest rates went down and kind of shimmied back, we got some of that loss back the next week in the securities market. So everyone's kind of like, okay, it's coming.
Anticipating it. So, okay, Jeff and Bobby, I'm curious, over the summer, we had, and this is anecdotal, but just speak to kind of your experience. Seems like more buyer activity. How much of that do you believe that to be true? And then B, how much of that do you think is just the summer selling season? And how much of it is like rates are stable, we're going to get off the fence now? And then we want to talk about kind of like buyer behavior moving forward if rates do drop and what we anticipate. But kind of over the summer, what's been your experience?
Yeah, that's a good question. So what we have seen, we do see a lot of buyers coming to us, and this is just our team. So, and actually in Keller Williams, we've had a lot of buyer closings this summer, right, Bobby?
We're actually even still.
We're even.
Our listings
Okay.
and buyers is about, it fluctuates
So
a
it's
bit,
50-50?
but we're pretty even with 50-50.
Cool.
Yeah.
Yeah, but we've had quite a few buyers approach us and looking to purchase a home. And we've been able to close a lot of those buyers. Like Mike's saying, I think his example about, what was it, percent of people need to sell, 72% of people need to sell.
2.6.
Yeah. So they either have just sold or they are doing contingent purchase. And then we do have some first-time buyers as well. So it's like a pretty even mix. I think it's definitely gone up compared to the beginning of the year as far as our buyer intake. So
Yeah, and just because we've closed about 50-50 doesn't mean more buyers haven't entered in. We're just waiting for the inventory for those people. So we see that with our agents are busier with buyers, but we haven't caught up yet.
yeah. Yeah. And I guess for every seller, there has to be a buyer.
You'd hope.
So
Those are good transactions.
yeah, that's helpful.
They work.
So that might be why we get about the 50-50 in Keller Williams, because we have pretty big sampling. But I think generally in our office, I think we are working with quite a few
Yeah, and
buyers.
if you look at the population of Keller Williams agents, a lion's share of them are representing buyers. I think there's a decent sliver of people that are doing the listings at Keller Williams.
Yeah.
But you have so many agents that I would say probably 60 to 65% of those agents are bringing the buyers to the market, where the other 30, 35 is actually bringing the market, bringing the house to the market.
Yeah.
So to balance that out is really, it's a great. But I'm curious, back to your question, so I kind of poached this question, but I'm in it now.
Yeah.
Do you feel like the psychology that I've heard so many agents whisper into their buyer's ear, which is like, you got to get a house before the rates drop. Do you think that's stuck? And is that what's motivating people? Or is it just impatience? Like, I can't have a 2-bedroom, 1-bath house any longer. I have to move up.
Probably both. But I think buyers, my sense is, and Travis, I'd love to hear what you think.
Yeah.
My sense is that buyers are like tired of waiting. So I think they're like, whatever, I need to do something. I'm sick of getting my rent raised.
It depends on the agent too. If an agent is really good at explaining what's actually going on and the buyer's relatively capable of understanding, then that buyer's off the fence. Like if an agent can thoroughly and actively explain why this is so important and what's coming, then I think anyone with, I've got to be careful.
I do think a lot of buyers like lost trust in us though, Bobby, because like we were saying that rates were going to come down a long time ago, right, Mike? I mean, all of us were thinking that rates were going to come down and they didn't. So, and it's been like a year of us saying that. So it's kind of like, yeah, you've been saying that for a while. Are they really going to come down? Well, finally now with the jobs report, yeah, they're coming down.
Yeah, it's kind of a delicate conversation because I feel like it's less about what's coming, what's been all of it. It's what can you afford today? Can you afford the payment? And long run, we know it's best to get into the market.
Yeah,
so,
and the appreciation is going to outpace
easily
your savings.
I think that the conversations I've had with buyers, when you explain that, here's what's known as crystal ball, here's what's likely to happen, everyone gets it. I think though, so yes, I think more buyers are coming off the fence and being willing to buy. I just don't think that they're willing to settle. And so in a low inventory market, I think, we get the math and we understand, we believe you, like we're in, but they're not going to settle on a house just to get into the house before everyone else does when rates drop. So that's been the sticky point, is still the inventory problem being low. And like you said, when we started, there's not a ton of it. When they come up, it's like,
they're waiting to fall in love.
They're waiting to fall.
Everyone falls in love with the same.
Yeah, I know. So that makes it a little bit challenging. So I think the psychology is like, I understand what you're saying and I believe you. We're still not just going to jump on a house just to jump on a house. Yeah.
You don't get rejected right off the bat when you have that conversation. It's prudent logic. Like, you'd want to get to the market before everyone else does.
Yeah.
If you could pay to be the first 5 people in line on Black Friday for that Best Buy TV, you would do it.
Yeah.
Because, everyone else behind you is going to have to wrestle each other to get whatever's left.
Yeah.
But I absolutely agree with you. This game is chess, not checkers. So you have to have a place. Every time I'm in a first-time home buyer conversation, I don't know if agents love this or not, but I say, hey, could you see yourself here for like 5 to 7 years? Because if not, we don't even need to talk about buying down the rate. Let's just get you comfortable for the next 3 years, because you're going to have to come back and talk to Travis about selling, and selling is a lot different than buying.
Yeah.
And we made some promises about rates dropping, and rates started dropping. Back in March, though, we got this weird little blip where, hold on a second, the PC is going up, and inflation's up, and gas was up again, for God's sakes. And so the rates went up again and that's just to pepper in again. The banks were thinking, all right, we're coming down. And then that happened. That report came out of nowhere, and they immediately said, whoa, let's get back up there. Let's get back up to 7, 7.25. Sometimes based on your credit, 7.5 in March. And you're like, great, we're going into buying season, and rates are going the wrong
direction. Yeah. Yeah.
And now my client's not picking up when I call them.
Yeah, exactly.
This is going to be a great season.
This is going to be awesome.
It's been interesting hearing the Fed's talking points saying that they need confidence. We need confidence. And so that sort of stability and is inflation going the right direction, and is it sustainable, and all those kinds of things. And then jobs. I mean, the Fed's got this dual mandate, like we've been talking about. They want to have the soft landing, like everyone's been talking about, without going into full blown recession. Although I will say, because you mentioned recession, I feel like every time somebody says the word, people think as it relates to home buying that I'm going to wait because home prices are going to go down.
Right.
But 4 of the last 6 recessions, sales prices have increased, not decreased. So it's not a one-to-one that if we go into recession, home prices will drop. Historically, it's opposite. They continue to rise. So just that caveat as well. It's not that you should wait for a recession, which no one wants that, in order to buy cheaper, because it's not usually the case.
But it does force people to re-question their decisions, right? How stable is my job?
Yes.
How stable
Yeah.
is.
Yeah, that's true.
And all of a sudden, the parents that are like, here's $250,000 for your down payment. They're like, well, you know what, honey, hold on. Maybe we should just wait and see what happens. I don't want my $250,000 to go down to $200,000 the first 2 years you own the house.
Yeah.
And so there's this shift in thinking. I do believe that the Fed mandate, if you want to touch on that just really quickly, is that they're okay with a 4.3% unemployment rate. What they're not okay with is that it's jumped from 3.4 to 4.3 in 6.5 months. And so that falling knife needs to be caught.
Yeah, and it's tough because it's not like they can say we're just waiting for jobless claims to increase. You know, I don't think they could say that, even though that's kind of clearly what's happening.
Well, it was a quick increase. I mean, that's what scares them.
Yeah, there will be an ugly time where more and more people that we know are just like not able to go back to work before this corrects. But I mean, I think what's really interesting though, with regards to the next 12 months, is we're kind of going through the end of our buying season here on the Central Coast. I feel like our buying season easily goes to October, like well past when the kids go back to school, just because the weather is so tremendous here. And we could hit the last portion, this fourth quarter of our buying season. So to be clear, that's like September 15th to November 1st, where we could be in a nice little sweet spot where rates are coming down as inventory is still on the market a little bit longer, and kind of stretching past when it needed to. And that's a great opportunity to buy. That's a really good time to think about this.
So rates will likely drop further after these cuts, September. Who knows where they'll land, but if we're at 6.5, maybe you think they get in the fives, high fives? So
I quoted someone over the weekend with 25% down on an $800,000 house, so less than the median home price in San Luis Obispo. And for 2 points, they were able to buy down to 5.875 for 2 points. So that was $11,000 to buy down to 2 points. I talked him out of it because even though an interest rate that starts with a 5, why would we do that right now? But 1 point buy down was 6 1/8, 6.125.
That's fantastic.
And their rate with no costs was 6.5. And so that I say that ladder, that chunk of rates, because everyone says, oh, we've got the lowest rates. Every lender has all the rates. It's a question of how much they need to charge you. And what I do is I try to watch how fast we go from the zero cost rate, 6.5% in this example, down to that 6.1% rate.
Yeah.
I think that we are going to slowly lower rates, though, because of what I told you in the beginning. Banks don't want to cut their paycheck from last month to get a paycheck this month.
Right.
So we always lower slower, and we raise rates like there's no tomorrow.
I was hoping that one rhymed too.
Yeah.
I know. I was trying to go slower, so I was like,
where is he going?
Just land it. Just stick this one, Mike. I want you to stick it so bad.
Can we do that?
We'll go back. Yeah. Cut.
So that's always, so consumers just remember how fast they went up, and they must come back. It's like an ocean tide. It must recede as well, but it doesn't.
So
because of the income model that we have.
That's good to know. Yeah.
The dark side, ladies and gentlemen.
Unfortunately, we have all the money, so we make the rules.
Yeah. That's what Jeff says. This is crazy. So the big question mark for me is volatility has been a prop. Obviously, no one wants like 8% rates, although interest rates are a double-edged sword. The downside of higher interest rates is it affects affordability. The pro side of higher rates is that you're able to build inventory, which really helps. Lower rates, better affordability, more competition, potentially like competitive, higher prices, all that kind of stuff. So I understand the affordability is a really big deal. I get it, but it's a two-edged sword. So higher interest rates are tough. Volatility is really hard because you don't know how to budget and how to plan and all that. So do you think wherever we land, low sixes, high fives, whatever, is it sustainable? And I guess I'm not so interested in the answer to that question because it's a little bit of a crystal ball thing, but I will ask this: what market conditions would need to exist for it to be sustainable?
That's a great question. So let me unpack some of that really quick. So what you're saying is that rates stay between, did you say 5 and 6%?
I don't know where they land. I guess wherever they land, they're going to land. We're better than we've been in over a year. My question is, wherever they land.
So even right now.
What would it take for this to stay? Or it gets to low sixes from 6.5. We are at 6.25, which we'll take it. Honestly, we'll take it.
We'll take it.
But how does it stay there?
Yeah. It's never going to stay there.
Shoot. Well,
I'm sorry.
Thanks for being here.
You're fired.
But I do, here's what I will say. I say when we have 3 to 6 months changes where we let the rates drop, we let those consumers make a choice and act on that choice, then we have a market that steps down naturally. What we don't want is a rush to 5.5% interest rates. Is it great for agents? Sure, you got a lot of sales, but it's not a sale that I think you want to be making because you're now convincing your buyer, hey, look, you're contingent. Unfortunately, we got to be at 103% of this list price to get this thing. And by the way, when we sell your house, we got to sell that thing fast.
That's the double-edged sword, right?
We got to sell that thing fast. Yep. So what is perfect? Nothing is perfect. Mm-hmm. And it shouldn't be.
Right.
Because if it was perfect, then everyone would do it.
Mm-hmm.
But I think if we step down, we stay at 6.5 now till, let's say, October. But in that 6.5 range, if that's the zero, we see weeks where we're like, 6.25 is 0% interest rate. And some good news came out for the economy, so we're back to 6. And then bad news, now we're down to 6.125% is 0. That can get people back to market in waves, which I think is natural. Mm-hmm. We don't want one big crashing tsunami. It's going to be hard. We're going to have to sort out all the bodies.
Yeah, and we're used to that. Even during COVID, we had that every few weeks. It felt like a very different market. Mm-hmm. Even though generally it was crazy, but 1 week you'd be going, okay, is this it? Are we coming back down now?
And real estate is so local. Like here, I think what happens in our small, little slice of paradise is that you have one or two of your friends. It's, so we were able to sell our house. We got out of the crazy ultra low mortgage, but it wasn't that terrible because we got a 6.125% interest rate. And with all the equity we brought in, the payment was only like $800 or $900 more. But now we live in AG or whatever it is.
Yeah.
So those stories need to start being pumped into our social circles. And then the people that are like, I'm never selling my house because I have a 2.375% interest rate. That's fantastic. But do you have the ability? Are you liquid enough to go buy the next house?
Yeah.
Because the house you're in may not be for you. And so what I would like to see, to answer your question, what I think is perfect is a step down where over the next year and a half, we get to about 5.5%. I think 5.5% is a reasonable rate where a lot of those ultra low mortgage people will still just stay with their house they have because finances dictate how they make their decision. It's like their number one line item is like, I got to have an affordable house and I can retire and I have this. But it's also going to allow some of those people that have those ultra low mortgages to release some inventory back because the change in payment is not going to be that bad. And they probably will stop seeing huge appreciation years. Like that's another reason why people hold on to these houses.
That's a great point.
Is they're like, I just made 6.8% and all I did was mow the lawn.
Yeah. Yeah, right. And on the whole amount, not just your
that's right.
That's the crazy thing about leverage. It's like you can invest $50,000 into the stock market and earn appreciation on that, or you can do the same with a house and earn appreciation on the whole, on borrowed money. It's crazy.
Yeah. And when you so I think that's the other part of this is like the people that have the ultra low mortgages, they're tired of talking about how low their interest rate is. It's old to them. It's great. But what's a lot of us, their huge sex appeal is that they're getting year after year after year return. Yeah. When rates come down, and they come down slowly and maturely, I think we won't see these crazy income or appreciation hikes, excuse me.
Yeah.
But if they race down to 5, I think we could see a 10% increase.
Like we saw 3 years ago or whatever, we had these crazy swings.
We're going to have to start writing offers with appraisal gaps. I'm going to have to tell people, look,
here's my firstborn.
Are you aware that your contract price is $40,000 more than what this house appraised for? Please sign this letter.
And they were.
Yeah.
And they were happily.
In San Diego was
letters.
crazy. Yeah. I did one for $95,000 more on it was like a $1.1 million house. So 10% more than what they were in contract for is what they paid for the house, or 9% more. Whatever.
Wow.
They're still sitting in a good spot though.
All right, Mike, question for you, and then we can open it up to these guys too. But I love what you said. There's no perfect market. You just have to know the market that you're in and then make a decision. So what advice would you give buyers and sellers as we enter into this season of potentially, lower rates? How would you encourage people?
Yeah, just like I would get a football team ready for the season, I would say we got to get good at the stuff we can control. What are the things we can control? If we're selling, let's get those projects done. Don't go wine tasting again this weekend. Let's get the projects done. Let's hire a contractor. Let's write it up as an expense for owning real estate. Mm-hmm. Your life is not that tough. Next, I would say. Next, I would say.
Bobby's just disapprovingly shaking her head. I get that look a lot.
He's used to it.
It's a first world problem.
Yeah,
right?
totally.
Yeah,
I had to hire a contractor that's fixing my appreciation house so I can sell it and
good problem
take
to
the
have.
capital gains exemption.
Yeah.
The second thing I would say, so there's that, but also you got to start decluttering. And decluttering means get yourself in position to start showing your house. That's what it means. It doesn't mean throw out plants and things like that. Just get yourself in position. If you're a buyer, this sounds like a broken record, but get a pre-approval with a professional that gives you options. Okay. Why are we getting pre-approvals that just say, this is your max? Knock yourself out, kid. Yeah. Let's get options. And what does that mean? Look, is it possible that we could restructure some of your personal finances and pay off these credit cards or maybe high yield personal loans or even some student loans? Let's take a larger mortgage on your house that is a tax deduction.
Yeah.
Okay. There's limitations in what the tax deductions are. And if you'd like to talk about those, I'm happy to talk about them. But for the sake of this podcast, to keep it fun, I think we got to control what we can control and really start being ready to jump, because this is almost like a scenario where you're going to have a week where rates drop again, and all of a sudden I think you're going to have all those sellers that found a house that have to fire sell their house. So they get in contracts and they have to fire sell their house. That's the property that I hope to be accepted on today in San Luis Obispo is that very situation. They went out and found a house over a weekend. The rates went down in early August, so it got them into that price point they were at, and now they're selling their house in San Luis for under market.
Wow.
They just took I think they're
Give
taking.
us the address of that.
Yeah. Y'all want the
Heads
address?
up offline.
The property is probably about 25 to 30 grand under what I think it could go for in the San Luis Obispo proper area.
I'm in escrow on one as well, where I thought it would. I think we're at least $40K under market.
Yeah,
which is interesting.
So that buyer that got that pre-approval done, they're ready, they're excited, they can act on this. The sellers, though, this is the message to the sellers. You went out and found a house before you were ready to get your house into contract. You need to list your house.
Yeah.
You need to listen to these professionals that say, hey, we don't have to release your shelter unless you find something else, and start playing that game right now. Is it work? Yes, it's work. Do you have to show your house when you're working from home? Yes, you do. But get yourself in this position where, wouldn't you want to be on market the day that interest rates hit 5.875 and that buyer's like, oh, now I can afford 30 grand more. Let's just offer him 30 grand more and we'll get the house.
Yeah, it's good.
Yep.
That was good
Good.
stuff. Man, the myth, the legend, Mike Poyntz.
Yeah, he's good.
It's not really, there's no special formula, but it is a marketplace. And a lot of times people think, well, it's just a place where I live. But every house I drive by in my head, I kind of see like, you know, this one's open for business. This one's closed. This one's open for business.
Yeah.
And you need to think about that if you're in the market, that, you know, you need to like get out front and sweep the sidewalk before you open and roll a carpet up and be like, come on in.
Yes. Yes. That's a good way of thinking about it.
Cool. All right. Well, let's get to
Mike.
know Mike a little bit better. Okay. 4 questions we ask everyone. You ready?
Oh gosh, yeah.
This is like the hardest part of the podcast for Mike. Okay, question number 1. What's your favorite book, movie, or TV show?
Yeah, I'm behind in my reading, so I'm going to go with TV show. And all-time favorite TV show, I'd probably have to say Seinfeld.
I knew that was coming.
I'm a Canadian first.
Okay.
The one that I, cringe at saying, but I'm still going to say anyways, is because I think this world can be a dark place, but you have to be smart, is House of Cards.
Oh, okay. I never saw that. Dang it.
It's very evil.
Is it evil?
Oh, it is. It is evil.
Yeah.
It's evil, but in a way that helps you appreciate, kind of how this country can and probably does run.
Yeah.
Can I ask you a follow-up, which I haven't done, I don't think? Oh,
Okay.
well, okay. I know. Sorry, we're running out of time.
Go.
I love nerdy stuff too. Curious, what resources do you go to for education on real estate? What do you love? Lending, real estate, the whole thing.
Yeah. I follow Barry Habib like clockwork. He is a long time, I would call him an economist. Mm-hmm. He speaks specifically to the mortgage loan officer about the bond market and, the mortgage market. For real estate, though, I honestly watch a lot of YouTube about these agents who, and not like flippers and wholesalers. I mean, that stuff's interesting, but these agents that run amazing practices. One of the guys is down in LA. He has the show Impossible Listing. Mm-hmm. I don't know if you've ever seen it. Just the way he runs a practice gives me insight, because I don't practice contracts like you guys do. But here's the thing: I'm in a contract every day.
Yeah.
I'm obligated with you guys, so I like really get fascinated about how to navigate that conversation.
That's something I have to say I appreciate about the way you work, is just because you're not in them and it's not your job doesn't mean you're not assisting and teaching and like kind of game planning with us on the contracts. So that's huge to have a lender who's aware of it and jumps in with both feet.
Yep, absolutely.
It's a tricky line though, right? Like when I come across to an agent, I'm trying not to say, hey, this is what you should do. Mm-hmm. But it is part of the time, it's my job to say, hey, the bank's not going to allow this.
Yeah.
We got to get around that.
Yeah. Okay.
Cool. Well, hey, after Bobby, who's the most influential person in your life?
Bobby's been pretty high up there this year. She's been great for me with this new segue I have. I have a corporate partnership with Keller Williams, and Motif Mortgage is very honored to have that. She's been terrific with that. Absolutely terrific. My old broker from the company I left was a very influential person in my life. I want to give a shout out to him, Jason Grody. Unfortunately, we're just not joined at the hip anymore because of the way business works. And the last person I would say that gives me, that influences me is my father-in-law. I have a great relationship with my father-in-law. It's actually a blessing.
Wow.
That's so sweet.
Yeah,
That's the
so
first time
cool.
we've ever got father-in-law.
Yeah.
Pretty
good.
That's special.
My dad's great. He's like a silverback gorilla. He'll protect you to the end of his life. But my father-in-law and I are like you've heard this, like you marry your father.
Yeah.
There have been like 100 things where I'm like, yep, that makes sense. Exactly what I would do.
That's funny.
That's so funny.
Yeah.
I love it. Okay, this is my turn. Describe your ideal day on the Central Coast.
Okay, so it starts with a walk or a hike with my girls. I have 2 dogs that I love, Luna and Stella, and I just cherish the moments with them. Unfortunately, they don't have the same lifespan that we have, so I literally try to take time with them whenever I can. And then I probably would come home and walk. I live about 6 blocks from downtown. I live in downtown San Luis Obispo, so I'd grab my lovely wife and we'd probably walk to a place that serves pastries. I'm a big pastry fan. I think you should have 1 pastry a day.
Amen.
And
Love
then
it.
you won't have to save money for retirement because you probably won't make it.
Live it up.
It's small It's a small contribution to my retirement.
Yeah.
But I really, really love our town. And I loved that we have the topography where we can get out to hike. I'm not a big beach fan. I just don't really like the sand.
That's fine. It's okay.
Again, not a surprise.
But I do love, like the wine tasting and the beautiful like views you get with wine tasting. So that would be a great Central Coast day for me.
I like
kind
it.
of find my way to all the things I love, which is the hills, the wine, and time with my wife downtown.
Great.
Nice.
Good answer.
Good answer.
Question number 4. What is the best way for people to get in touch with you?
So I have a website. It's called advicebeforeprice.com.
He loves a good rhyme.
Advicebeforeprice.com. Because, I get called all the time, what are your interest rates? We kind of got referred to, and I just stop right there and say, well, before we talk about rates, like, what are we trying to do?
Yeah.
What property are we buying? Who's this for?
Yeah.
How long are we going to be in this thing? Do you even have money? These types of things are important. So Advice Before Price, you can find my phone number and contact me there. I love to get on the phone still, but I know a lot of people don't. But you can call or text me at 805-234-0903. And I just read a meme the other day that says if you repeat your phone number twice, that you were born in the 80s.
Oh, gosh. I always repeat it.
100%.
So it's 805-234-0903.
What a stud.
Mike Poyntz, thanks so much,
on.
man.
Yeah.
Great
Good to have you,
conversation.
Mike.
We really appreciate your time. Thank
Thanks
you.
for having me. This
Of course.
was great.